So, hello everyone, and welcome to another one-to-one mining investment online content session. Today we have the gold investment outlook panel, and our panelists today include Sunil Kashyap from Scotiabank. We have Samson Lee from Refinitiv, Thomas Puppendahl from Chancery Asset Management, and Wayne Gordon of UBS. And now I'd like to give each of the panelists a chance to just give a quick intro to themselves. So maybe Thomas, if you'd like to kick us off.
Okay. Yes. Hi, Amy. Nice to see you on online this time. Yeah, quick intro to Chancery Asset Management. We're actually not managing assets of other people. We're pretty much focused on managing our own assets especially since last year when we took over a gold project in Brazil. We are in the process of restructuring this one and doing an RTO on the TSX, and also launched another gold project with a TSX listed company just a few days ago. So we're pretty much turned from investors to like sort of miners ourselves, but still from an investment angle, of course. So that's our main focus right now.
Okay, great. And Samson?
Hi, I'm Samson Lee of Metals Research. I'm mostly responsible for conducting research and then forecasting the supply and demand, mostly the demand for the precious metals in mainland China. At the same time, I'm also have many years of investment experience, particularly focusing in the mining equities sector, including the junior explorers. So I'm also kind of well connected within the mainland China's mining and industry. Thanks.
And Sunil?
Hi, I'm Sunil Kashyap. I work in the metals team in Scotiabank in Hong Kong. And over the last 20 years, most of my involvement has centered around the physical markets in Asia. Hopefully I can share some of my insight in terms of what's been happening in the physical investment and jewelry markets in Asia over the last few months.
Great. And finally, Wayne?
Yeah, hi everyone. It's nice to be with you. I sit in the Chief Investment Office in Global Wealth Management for UBS. We tend to look very much across asset. So from a precious metals perspective, we look from the physical trading side, as well as in equities, as well as gold mining bonds. It's very much a cross-asset type coverage. Of course, we're one of the largest gold traders in the world. We also look on the rate side as well, being very important to gold and some of the macro indicators. So it'll be a nice discussion today.
Great. And I guess to kick things off, obviously the key theme these days is the impact of COVID-19 and how that's impacting different commodities markets. So I guess if maybe we could talk about the impact that it's had so far on the gold market, on supply and demand, and especially on pricing and where we see things moving over the next year. I don't know if any of you want to kick that off.
Maybe I'll go first.
Sure.
Yeah, sure. As I mentioned earlier, I mostly focus on the Chinese market. So this year, it's quite abnormal or unusual in the Chinese market. First of all, due to the COVID-19 situation, the mainland China's gold imports have fallen to probably to the lowest level since like at least 2011. And then like in April, mainland China has actually become from a net importer of gold from Hong Kong, the city, into a net exporter to Hong Kong. So it is quite extraordinary. Why has that happened? There are two reasons. The first is demand has been weak, but the supply have been like relatively abundant in China. and then which caused to the Chinese gold price, which was usually trading at a premium against the Western prices, have fallen to trading at a discount, like since end of February or early March. Especially the discount was as large as like $70 US per ounce discount, like in April. So like when the domestic price is so cheap compared to the overseas gold price, there's no need to import much gold in theory. So that's why so far the mainland's gold imports has been quite poor so far this year. But the good news is, as the Chinese economy has been like kind of slowly improving, as well as the spending sentiment has been improving slowly, we also see the demand has been picking up somewhat. And as of now, the Chinese gold price is now trading at a discount slightly higher than $10 US per ounce. So I think the supply and demand situation in China has been improving. And I suspect that if the gold price continues to do well in the long run, I think investment demand for gold in China will definitely picking up.
Yeah, if I can add to that, Amy, it's quite interesting, the contrast in the markets, in the physical markets. So like Samson said, we've been scratching our heads because China has been running at a huge discount. It traded down to $70 discount, currently trading at $10 discount. That same kind of situation is getting played out in all the major physical markets. India is running at a discount, as is Thailand. And so as and when the government is opening up, you see lines of people standing outside shops in Thailand, for example, selling gold. And similarly in India, we've heard stories of people going to jewelry stores and selling gold. And I think it's all driven by the fact that the prices in local currency are much higher than we saw, let's say, 3 months ago. And so people are trying to take the opportunity to take profits. But also, I think it's also people who, farmers or shopkeepers who haven't got any other source of income are actually liquidating holdings to try and get hold of some cash flow so that they can buy food, etc. And that contrasts incredibly with what's happening in the West. The markets in New York, COMEX, which typically trades very similar to the London markets, has been running at a huge premium. And in March, we saw the premiums in COMEX in the futures market trading as high as $70 premium. So whereas you see China at $70 discount, you're seeing New York at $70 premium. That differential typically doesn't exceed more than $3. So you have seen a lot of dislocation in the markets. And I would say New York, the fact that futures are trading at such a premium, I think reflects the fact that there's a lot of investment interest in New York in the futures market. People feel that gold prices are heading higher. And so that's why you've seen that kind of buying action in the futures market, which is also getting reflected in the ETF market. The ETFs, gold ETFs in New York, have seen a steady accumulation of holdings over the last 6 to 8 weeks since we've had this pandemic situation.
And
I think maybe if I can just pick up there a little bit, Amy.
mm-hmm.
Clearly, as we sort of look forward, because those events that have just been described have been very interesting sort of, I guess, events that have occurred because of COVID, largely, I guess, on the spread between New York and London, the impact of refineries shutting down in Switzerland, air travel being disrupted significantly, which caused those sort of dislocations in being able to meet ETF demand and so forth. The key thing for me, though, going forward is our forecast for gold at UBS is 1,800 over 6 and 12 months. Now, when you look at the current spot price today, that doesn't give a lot of upside. And that gives a bit of an indication of where we think we are in the macro cycle, in the sense that the Fed has done a lot of easing. That, of course, has supported gold prices higher. Obviously, initially, when the crisis hit, equity markets got hit hard, as we saw in the global financial crisis. Gold tends to be the first thing that's liquidated to make margin calls, etc. And so it has been very high volatility in gold prices. In fact, significantly higher than what we've been used to over the last couple of years. But the key thing for us going forward is what happens to real interest rates in the United States. Now, the Fed have clearly ruled out that they're not willing to go negative, and they don't see the need to go negative. And then inflation expectations, unlike coming out of the global financial crisis, are very, very subdued. In fact, what COVID has probably delivered to us is disinflationary pressure, if not deflationary pressure in some countries. So the outlook for real rates is a little bit problematic to push gold significantly higher, particularly to the sort of numbers that I've seen around the place, are around the 2,000, if not even higher. In the case of one broking house, I think was calling for a $3,000 gold price over the next 18 months. So for me, in the outlook, to see prices move significantly higher from here, and I mean prices moving to around the 2,000 level, I need real interest rates in the United States to dip deeply into negative territory, and I mean potentially below the negative 1%, which is where we sort of see it at, which is consistent with the forecast of about 1,800. And you would need to see further dislocation from COVID. So you would need to see probably second round effects starting to play in, which would lead the Fed to need to do even more than what they've done already. So for me, the gold price with exceptionally elevated ETF holdings of gold at this point, to get people to move more money into gold, we think that you need to see real interest rates start to really dip into negative territory, and that looks very problematic, at least at this stage.
Okay, yeah, I think we should look at the short term versus the longer, mid and longer term impacts of COVID. Short term, we've seen, as Sunil said, dislocations in the physical market, and then you hear people talking about a potential short squeeze on COMEX. Those were short-term effects, which were essentially due to logistics, because the Swiss refineries had shut down and people had to move gold from London to New York. So while it's had a huge impact on the physical markets, that's probably unprecedented. I would think this was a very short-term logistical event. What's more interesting is the longer-term macro impact of what's recently happened. And I don't think the virus itself was much of a, or is much of a reason for gold to go up. It was certainly the trigger that triggered something that was brewing anyway. And it was probably the black swan that no one saw coming, because everyone knew that the financial system is overstretched and the debt bubble had to burst. But no one saw the virus coming along and trigger all of this to collapse in a very short time. So I would think that COVID triggered something that was overdue in any case, and gold was ripe for a new bull market because of the irreparable over-leveraged financial system, and the response by governments and central banks will now only accelerate what was going to happen anyway. And we've already seen central banks printing even more insane amounts of money, which is actually, of course, the classic definition of insanity, trying to do cure a problem with the same medicine and expecting a different outcome. We've seen that printing money hasn't done much so far, and now the money printing has gone into complete overdrive, and all limits are thrown out of the window. And now people say, okay, the last 10 years since 2008, since the beginning of the financial crisis, hasn't created the massive inflation that the gold bugs were expecting all along. And that's true, because all this money that was printed in 2008 and subsequently never really went into the real economy. It was trapped in the banking system, and the velocity of money has been very low. So it never created the actual inflation as measured in the official indicators. And there's been asset inflation in the bubbles everywhere, in the stock market, real estate, and so forth. Now what's happening, central banks are printing more money. So is it going to be any different? Is it going to create finally the inflation? Not sure, that remains to be seen. What is slightly different now is that central banks are now calling for governments to engage in fiscal spending, because central banks are at the limit of their tools. And now governments have started and will probably accelerate fiscal spending, but it's all the same, because who's going to pay for fiscal spending? It's going to be monetization of government debt, again, by the central banks. So I think from that point of view, there is a lot of upside for the gold price. And I'm not so sure about whether the Fed will stick to their commitments to not go below zero rates. Negative interest rates are, of course, completely nonsensical. But we are in a world that doesn't make any sense anymore financially. And who knows what's going to happen when the Fed figures out that they have to put down another fire. And what Wayne said, the key factor for gold is real interest rates, which is the single most important correlation between interest rates and the gold price. And I think there's a lot of room for interest rates, real interest rates, to go very negative over the midterm.
If I can just make one closing comment to answer Thomas's view, I think on the futures, I just want to close that, because there is something that's quite strange that's going on. I think everyone in the market thought, just like Thomas said, that there's a short squeeze, especially on the April contract, and so that's why the price went higher. But the interesting thing is, those positions have got rolled over into June, and June went into a premium of $25. And now if you look at the same positions, they've been rolled over to August, and August is trading at a premium, and some positions have been rolled over to December, and December is also trading at a premium. So I think what Thomas and Wayne have said is, clearly there seems to be some amount of bullishness in the market, which is not goes beyond just the logistics kind of answer that people are looking at. So there is some amount of concern about the future, and that's why you're seeing that buying taking place in the gold futures right up to December.
Sir, I would like to add one more thing about the gold market, because again, I think it's a bit strange or extraordinary. As Sunil mentioned earlier, like mostly the Asian markets have been selling gold, while the Westerners have been like buying physical gold, especially when you look at the situation in the ETF, like lots of capital have flown into the ETFs buying physical gold so far this year. But at the same time, while the physical demand from the investment perspective has been quite high, we have to take notice about what has been happening in the futures market. Like I looked up at CFTC weekly report from by the last week of May, and I realized that the net managed money position in COMEX Gold has fallen to the lowest level in the last 51 weeks. What does that mean? That means the physical buying for investment has been going up, But at the same time, the funds who usually like speculate in the futures market, they have not been fully all in into the gold futures market this time, not yet. So in the longer run, I'm pretty bullish on the gold price, because once these funds come back into the futures market, I think the gold price is going to spike. Like to put this into context, like last Tuesday, the net managed position in gold was equivalent to like 460 something tons of gold. To compare to its historical high achieved last year, the net managed money position was like 908 tons. So with all those like money printing and then a chaotic economic environment, all sorts of things going on, it is quite a surprise to me that the net managed position in COMEX gold haven't achieved historical high yet. So I think from an investment perspective, I think right now it is quite safe to long gold, as long as you have enough financial muscle to weigh it out.
Yeah, that's a good point. And just following up on this, it is indeed quite extraordinary that the investment demand for gold has been relatively low recently, and yet gold price is up, and it's almost like a stealth bull market, because people look at the US dollar price of gold, and even though it's already up 70% from the low in end of 2015, and approaching now its historic nominal high of 1900s very closely. If you look at gold in every other major currency, it's already at new highs and in a new bull market. Not even in emerging markets currencies. I mean, I look very much at the Brazilian gold price, because we have two projects there. In Brazilian real, you have the double whammy of a rising gold price and a weak currency. But in every other major currency, in euro, pounds, everything, gold is already broken out. So, and that's happened in the absence of, or essentially absence of investment demand. And like you said, Samson, the mainstream investment scene is completely out of the gold market. Everyone is chasing the stock market, and people have been conditioned to buy the dips. Every time the stock markets go down, people throw money into it and think it's going to go up forever. And gold, we've seen all these statistics. I think any gold exposure in mainstream investment management accounts is like a fraction of a percent. So it doesn't need a lot of money to flow into gold to have a substantial effect on gold price itself and the gold mining companies.
Yeah, I think that's actually a really good point. I just want to pick up on, particularly with regard to equities. We have seen a lot of different behaviour this time in gold equities relative to previous occasions when we saw spikes in gold prices. We tend to see significant pickup in capex, a lot of M&A deals that were being done that were too expensive relative to the longer term price. And so this time around, the behaviour has been very measured. They're starting to talk about distribution of cash back to shareholders, and the currencies being relatively weak. I look at the Aussie dollar as well. The real has been even weaker. But when you look at some of the bigger miners in Australia, the gold price has been at record levels in Australian dollar terms for quite some time. And we're actually seeing, looking at the World Gold Council statistics, we're seeing production under pressure, even with these high prices. So obviously, we'd expect production to stabilise, if not improve a bit. But nonetheless, we're not seeing the outlandish sort of capex spend that we've seen in the past. People are much more reserved. And I actually think that vies very well for not just gold, but also gold equities. At least just to quickly go back to the comments I made earlier, we still see gold as a credible insurance asset for investors. And it's performed as a very good hedge over the last 12 months or so. And we think that even though we have a pretty subdued upside to our base case in gold, it's clear to us that with US Treasuries where they sit, other asset classes which have been traditionally used as safe havens, gold is actually still a very, very credible safe haven. And as people take more risk to hedge a little bit, we still see gold as a very, very good option for people who are looking to take a bit more risk, but also continue to hedge the downside. And so I think, as you pointed out, actually, your holdings in managed money for in funds and so forth for gold is very low compared to other assets, and even a small incremental increase can see gold prices hold up pretty well, even as equities begin to rise.
Do you think, I mean, Wayne and Samson, do you think this is a reason why the overall M&A activity has picked up? I mean, we've certainly seen big producers in China going and buying assets in Canada. It'll be interesting to discuss about this M&A activity. Why has it picked up so much?
I think everyone has been bullish on gold, especially since last year. Like Thomas, he mentioned that his fund has bought some gold projects since last year, which is very good to him because one thing that I observed is not only this year, the number of activities picked up in the gold and M&A sector, the involvement of funds have actually increased. Let me show you guys a screen. So basically, some basic comparison about the mining deals. First of all, in the first quarter this year, you can see that the number of gold deals already surpassed at the same time period of last year. While the copper and other minerals deal, they were more or less the same. But it has been quite apparent that adding in April and May, not just gold, but also copper and other minerals still also increased on an annual basis. So I think in general, people have become more optimistic about the commodity price, not just in gold, but in other commodities too, because they think the base metals like copper and other minerals are cheap right now relatively to gold, and B, maybe they think ultimately with all those money printing, the global economy will enter a hyperinflation or something similar, that we'll see many commodity prices will be heading higher. But when we take notice on the gold deals, we can see that the second quarter so far, April and May, the number of deals have been increasing by a very large amount, especially when we see gold as a percentage of the mining deals. We can see that gold has made up at least over 60% of all the mining deals up till the 1st of June. So it's obvious that many industry insiders in the mining sector, while they are all bullish on all metals, but they're especially bullish on gold. And then I have some valuation of the gold so far this year. And then we can also see that up till the 1st of June, the average acquisition per total resource ounce have been much higher compared to 2019. Bear in mind that in year 2019, there were merger between Newmont and Gold Corp. So and the price that Newmont paid was not that cheap anyway. But the average in 2020 have been pulled up mostly by the merger deal of Alasa Gold and SSR Mining. That that deal was like acquisition cost was like over $400 per ounce, as you can see in this graph. So I think it means that mostly, while most of the people acquisition target have been like mostly focusing on the lower grade and maybe around 200 million ounce total resource, mostly in this criteria. But I think as the global economy have been opening up, like starting right now, I think we can all expect more M&A deals, especially in the second half of this year, because like I know there are many Chinese companies, they are very eager to acquire overseas projects, but because of the COVID-19 situation, all those logistics being shut down, so like they have to hold their horses back. But if situation improves in the second half of this year, I expect like there will be more M&A deals, especially in the gold.
Interesting. Does anyone want to comment on what Samson just discussed?
Yeah, thanks, Samson. That's a very interesting analysis. And I guess one main driver of the M&A activity is sheer size, the need to grow. Because to put things into perspective, in a stock market nowadays, you're considered a small cap if you have a market cap below $1 billion. I can remember times when people considered anything under maybe $50 million a small cap. But now with the inflation in everything, we're talking about billions of dollars, like people used to talk about hundreds of millions, and now the government debts are being counted in trillions of dollars already. So compared to the general stock markets, the gold industry, even all of them taken together, has such a microscopic market cap that companies still are just not being taken serious. For example, a gold producer with maybe 50,000 ounces a year will be completely overlooked by most of the larger gold funds. So there is massive pressure also for companies to merge, to just gain the size to even show up on a radar screen of investors. That's probably been one driver for the SSR and Alacer Gold merger. But what's also interesting is that now that we're at the beginning of a new bull market, the recent activity around Guyana goldfields, and you saw even companies like Gran Colombia, which was considered bankrupt a few years ago, with a market cap of over 400 million again, jumping into the ring and bidding for major assets. So there's clearly a trend driven by the need to become bigger in order to be taken serious by investors. And of course, fundamentals that companies are simply seeing the synergies of growing bigger, because as we know, the gold market is very scattered and fragmented still. You've got like 3,000 listed companies in Canada. Most of them are microscopic companies which shouldn't really be listed on its own. So there's probably a continuing trend to consolidate the market.
Kind of brings me into my final question, looking at new opportunities for investment, looking directly at mining companies. Where are investors seeing kind of the best value for investments these days? Is it within the producers, explorers? Where do you see most of the money kind of flowing?
I think it depends on at which stage of the bull market we are in. Initially, I think like maybe back in February, April, and May, I think most of the major producers like Barrick, Newmont have been doing very well. But right now, I think people are shifting their money from the major producers to developers and explorers. because I think maybe right now at this current gold price, they think the valuation of producer have been relatively fairly reflecting the current gold price, but maybe they think there are still like bargains in developers and some explorers. So if the bull market continues to run, I think people again will become speculative and then shifting more money to explorers.
Does anyone else want to weigh in?
Yeah, maybe I've gone through this question, or we are in the middle of it right now with our own project in Brazil, and it's very interesting. It's almost like there's two camps in the investor community, especially in the Canadian market. There's a very strong focus on exploration. Investors want the big elephant hunting potential for millions of ounces. On the other hand, more conservative investors like production, because at the end of the day, what's the point of doing exploration when you can never produce the gold? So it's very interesting that I think most investors at this stage in the bull market who are new to the gold market would probably prefer the larger caps and the established producers, because that gives them more visibility and more ability to kind of get exposure to gold via gold mining company. But the real juice, of course, is in the exploration, and that's what probably will accelerate during this bull market, where you're going to see success stories driving stock prices from 10 cents to $1, which is what people hope for when they invest in exploration stories. So it's almost like a dichotomy in the market. Some want exploration, some want production.
Okay, great. So that's it in terms of questions from me. Does anyone else, does anyone have any kind of final thoughts on the gold market, where we see things moving over the next half of a year, just to wrap things up?
Maybe I speak a couple of sentences. I think as the markets open up, what I hear from our people on the ground around Asia is that you're going to see a situation as soon as markets open, there will be some selling taking place because people are eager to get some cash flow. But the medium-term expectation is that as soon as things come back to normal in terms of the economy, the market, the jewelry demand should start picking up at the end of the year, and people are forecasting next year to be quite a good year for jewelry.
Great. So I guess if nobody else has any other final thoughts, I'll say thank you.
I just finish up at you by saying that to me the key catalyst here for the gold price is going to be how the Fed perceive the recovery of the US economy and also broadly the global economy. Clearly, yes, we would expect that as prices begin to come down, jewelry demand can start to pick up, particularly in India and also China, as those economies start to recover. However, the caveat for me is looking over the next 6 months is what is the catalyst to push gold prices higher? And that would be one of three things. We talked about real rates, but of course the path of the US dollar here is very important. If we see quite a significant debasement of the dollar, given twin deficits concerns and so forth, then you might see further upward pressure on the gold price as a result, and also equity market volatility. Over the next 6 months, we have a US election, and as we have seen, the chances of re-election of Donald Trump versus potentially the contender of Joe Biden is very uncertain right now, and we know that. Given the outcome of that, will also have an impact on the market. And that, as we saw on the last occasion, that also has a significant impact on the gold price. So I think there are a lot of uncertainties that will keep people invested in gold. But my key concern is, as we go into 2021, when does the Fed start to withdraw support? And that will be the catalyst to whether the gold price is able to hold its current gains, or it heads lower before it starts to head higher again.
Thank you.
Great. Well, thank you. So I guess that just about wraps up our discussion on the gold outlook for today. I'd like to thank all of the panelists for taking part today, and we look forward to seeing everyone live and in person again soon.